Welcome back. The Bank of Canada will announce a rate decision on Wednesday next week, and it will do so, of course, at a time when Canada is facing the possibility of unprecedented trade action against it from the United States. Let's talk about it with Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks for coming in this morning.
Thank you.
How does the Bank of Canada think about the threats coming from the United States? Donald Trump made more belligerent comments yesterday, aggressive comments, certainly directed directly at Canada in his address to the World Economic Forum. How does the bank think about this?
Yeah, we think that the Bank of Canada will cut 25 basis points, more so as an insurance cut, just in case anything does happen to the extreme. But then they'll take a wait-and-see approach, so it won't be cutting, easing every meeting, but we still think 250 by the end of the year is a reasonable target with some downside expectations. Yeah.
How significant is the threat of an economic slowdown prompted by the trade action in the United States?
It is less significant than last week. Let's put it that way. We're actually redeploying risk into credit, IG, and high yield. And the reason is that the points of clarity that we got this week are, one, Trump said he's putting this to a feasibility study.
Right.
Trump is not a feasibility study sort of guy.
No.
He's a ready, fire, aim. But with this, he's ready, aim, fire. So that tells us one thing. You know what? There's more negotiation behind that. Take that comment, feasibility study, and combine it with what Bissett, the nominee for Treasury Secretary, said. He said the goals, he encouraged people to look at the goals of tariffs. He said there's three things. One is bring production home. Two, it's raise revenue for the tax cuts. And three, it's gain leverage. So we feel we're in that gain leverage. They're trying to gain leverage against Mexico, against Canada especially. But they're not going to go 25% tariff. So it'll be much lower than that. So we're getting a sense of comfort, not necessarily for Canada, but for the U.S. And we're seeing that in the equity markets. We're seeing that in risk assets. So we feel we're in an all right position this year to start deploying risk.
And
again.
you said in some recent commentary you're bullish on U.S. risk assets at this point.
Yes, but being bullish on U.S. risk assets, it's being bullish on global risk assets. That's when, especially Canadian. If U.S. economy is going to do well, and it looks like at least for the first half of the year, it will. Canada will benefit from that. And that's why we're bullish generally now, increasingly so, comfortable with risk assets, U.S. as the center and Canada secondarily.
Back to the Bank of Canada, it will release a monetary policy report, which is quite a detailed assessment of its assessment of the state of the Canadian economy. How much of that report do you think will be devoted to our relations with the United States?
Yeah, they usually have a risk assessment in it, so they'll definitely have that. We're getting mixed numbers out of Canada. We had really good employment numbers, poor retail sales. I think the Bank of Canada cares more about retail sales and mortgage renewals than they do about employment at this point in time, especially when it's a good number. So we do think they'll show that in regards to risk assessments, that it'll be focused on that and the downside risks.
What's your view of the currency as the Bank of Canada cuts and there is much less confidence in the Fed moving down at the same pace?
So, very good point. So the interest rate differential, we feel the currency this upcoming on the 29th, because the Fed has the meeting the same day, that we could get further weakness in the Canadian dollar. We don't think it goes too much above or below 69 cents or above 145, the way, depending on how you're looking at it, just because that risk of tariffs is reduced. That was the kicker that could have, the exclamation point on a weaker currency. We think we'll be in this 140 to 145 or 69 cents to 70 cent range for the next little while. But interest rate differentials will be the main driver of that. And
do you see the Fed cutting twice this year in the U.S.?
No, we see no eases from the Fed this year.
Really?
Possibly a hike by the end of the year.
Is that right?
Yeah, you look at the numbers, they're on fire. They're basically on animal spirits now in regards to the Trump presidency, and you're seeing small and medium-sized businesses respond to that. So it's all dependent there, and there's much more of an inflation risk in the U.S., so you have to keep that in the back of your mind as well.
You've got a couple of bonds you like at this point. I think they're both Canadian corporate bonds. One is an Allied REIT bond. Talk to us about this. Here they are on our screen.
Yeah, Allied REIT is giving you a yield of approximately 4.90 for basically a 2-year bond. That's tremendous in regards to the pickup. Why is it doing that? It is investment grade by DBRS, but some rating agencies have downgraded it below investment grade. Our own assessment of the fundamentals of the balance sheet of the trend says, you know what, this is priced for the risk you're getting. It's a nice pickup, and it's low maturity. It's only 2-year holding, so we like this as part of a diversified bond portfolio.
Mm-hmm. And the Superior Plus bond?
Yeah, Superior Plus I wouldn't necessarily recommend for the everyday investor because it is high yield, but it is a very attractive bond from an institutional investor who's invested in hundreds of bonds like us. So this is an example of what we invest in. Again, a 3-year bond here that yields close to 6%, 5.80. That's almost 250 basis points above inflation. So we really like that. We like the balance sheet. We also think that they're a potential buyout target, which would accelerate the returns you would get on this bond.
Earl, thanks a lot for coming in.
You're welcome.
Earl Davis.